The lead story in the Wall Street Journal today about how bargain hunters are no longer buying the dips at this point. They say it's the first time that's happened since the dot-com bubble. Are you in a rush to get in here and buy at these levels?
What we're seeing is very confusing. Michael made an excellent point before about this is the third time we're testing down at the 2,600 level. That was our level as well in terms of support.
Fourth.
And then as you look out...
Close, anyway.
Yeah. Well, so we thought we would double bottom off of that. We've now triple bottom off of that. And then you look at the fundamental signposts that we've been focusing on in the last couple of weeks. The Powell lunch in New York, we got exactly what we wanted out of that. The Fed is close to neutral. The G20 dinner between Trump and Xi. We got exactly what we wanted there. We suspended the tariffs for 3 months, and now they'll have a chance to try to work out the details. Then this past weekend out of OPEC, we got a 1.2 million barrel per day cut. That, in our view, puts a $50 floor under crude. And now we've got the FOMC meeting to look forward to in a couple of weeks. So as we're looking at all of that, the core inflation has sort of come off the boil at 1.8%. The jobs report on Friday wasn't bad. The fundamentals would suggest that we should be grinding back up towards the old highs, not trying to pierce through the 2,600 level. So we'd like to see that 2,600 level hold. We'd like to see some bargain hunters come in and see stocks move up towards
But this is interesting. As you said, you've gotten everything you've wanted on every one of these key critical points, and yet you are waiting to see somebody else go first, right?
Well, and we've put some money to work, but we obviously, before we're going to put everything in, we want to make sure that the sentiment has changed. Now, we talked about, you were talking about the death cross on the S&P 500. That happened on the Russell, I guess a month or so ago. So technically speaking, there's pressure right now.
But what you would need to see is just this bid get picked up, other people willing to change in, because sentiment is what you think is ruling the day right now?
I think sentiment's exactly what's ruling the day. I mean, corporate earnings in the third quarter are pretty good. We think they're going to be decent in the fourth quarter. Talked about Stephen Moore coming on later in terms of the longer-term impact of the tax reform. We're right there in that camp. And the key issue was that $2.7 trillion of repatriated assets coming back into the United States. It's going to take a couple of years to work that money through on CapEx, which we think will help to drive the economy, not sort of a 1 or 2 quarter sort of sugar high.
Let's talk about where we stand in the cycle right now, the economic cycle, Jim. Is this the case where you're going to be coming up against tough comps as we get into the new year? Or do you really think that this has fundamentally changed the way businesses kind of view the world and what they can do with that capital? Has that changed the economic structure?
Well, I think part of the backdrop is certainly what's going on in the markets. I mean, we have seen more weakness in the markets than we have in the economic data, although there's been some moderation in some of the data as well. So, I mean, the question then becomes, to what extent is what's happening in the markets predictive,
cycle,
or is it self-fulfilling to some extent? And I mean, if the drop in the S&P 500 is 10% or so, I mean, it's not that big a deal. And for the most part, the numbers are holding up pretty well. I mean, there are pockets of weakness in housing, and certainly the export numbers look a bit weaker. But you look at the ISM surveys, and they're close to 60. The employment numbers are still pretty good. So I think overall, the economy still looks pretty solid. But, I mean, there are some signs of moderation here nonetheless.
And with the market weakening, you think that becomes a self-fulfilling prophecy simply because CEOs look at it and lose confidence and don't deploy some of the money that they might have been ready to deploy?
Again, I think if we're limited to a 10% drop, I don't think it's that big a negative. And certainly from the Fed's perspective, they do want to see some moderation and growth here. The goal here is to stop the downtrend in the unemployment rate, which means slowing employment growth from 200,000 a month to 100,000 a month or less. And I don't think we're there at this point by any means. So they're trying to slow things down without slowing it too much. I mean, they're trying to thread that needle. And it is a difficult challenge. The
other question coming from other economies around the globe that have slowed significantly, does that catch up to the United States, or are we able to kind of run things ourselves?
I mean, we look at the ISM survey that came out last week for manufacturing, and the export orders index in that report was 52 and change, whereas the first half of the year, that was over 56. So there is some slowing in export orders, yet you look at the overall ISM index, and it's almost 60. So far, at least, the overall economy seems to be doing okay, despite some slowing in exports.
Jim, Goldman Sachs, Jan Hatzius over there, changed his outlook in terms of the number of rate hikes he's expecting next year. He's pointing out that the market now he's looking for less than 50% chance of a rate hike in March. What are your expectations?
I think that's plausible. I mean, in my weekly this week, I wrote about that possibility, and we'll certainly hear out what the Fed has to say on December 19th. But they are certainly raising the possibility that they go more than 3 months after the hike in March, after the hike in December. Now, that doesn't mean they're done. And I think you look at what's
But a
in the bond
significant
market,
pause.
I think they've priced out an awful lot of tightening here. If the economy holds up and unemployment keeps falling and we still get well over 100,000 a month in payrolls, they're going to have to keep on tightening. But could they push it into the second quarter, the next move? I think that is plausible, yeah.
Hey, Phil, you said that you've been putting money to work. Where have you put that money to work, and what's your next target if you decide to put more in?
So where we put the money to work has been large cap value, and the things that have looked more attractive to us over the last couple of months have been some of the more defensive categories with the dividend payers. So those sectors of the market have looked better. To Jim's point, relating to Hasius, we think we could be a one and done situation here. We think the December rate hike is coming, but as you look out to next March, you've got the tariff and trade deadline with Trump, and then you've got Brexit coming up at the end of that month. The Fed may very well skip March and become data dependent based upon what's going on in June. And who knows what's going to happen 6 months from now.